Hey everybody, this is Crypto Quantmental here, and today I want to teach you about the Federal Reserve. You may not know it, but the Fed impacts your life day in, day out, ranging from how much it costs you to get a loan, whether it's an auto loan or a mortgage, whether you can get a job in terms of how high or low the employment rate is, and how well your investments or stocks are actually doing. The Fed has some sort of influence on all of those factors. So when did the Fed begin? It was legislated via the Federal Reserve Act of 1913. The reason for this act was due to a series of financial crises, especially bank runs. And a bank run was when the public tries to withdraw cash in mass from banks. Therefore, the banks become insolvent. The panic in 1907 was really bad, and it ended up leading to this legislation in 1913. To the right, you see Woodrow Wilson, who was in office as the President of the United States when this Federal Reserve Act was passed. So the Fed has three main responsibilities: to supervise and regulate many financial institutions like banks, monetary policy, which is the main topic that most people care about in terms of the Fed, and they do quite a few financial services because they are what is called the banker's bank. So what is the Federal Reserve System? It is the central bank of the United States. It has three main parts: one, the Board of Governors; two, regional reserve banks; and three, the Federal Open Market Committee. Now, this is a point of controversy here, but the Fed is a blend of public and private interests. The key is that all three parts from the previous slide operate independently of the federal government. Now, Congress has set the objective of the Fed, so clearly there's a public element there. However, member banks own shares of the regional reserve banks, which is a private element. And supposedly the Fed is immune to political pressure, but you see Trump the past few months, he's been tweeting all the time, trying to put some pressure on Powell to have a bit more expansionary monetary policy. So are they really immune to political pressure? That's kind of up to you. What do you think? So what about the Board of Governors? I mentioned Jerome Powell. He's the chairman of the board. So the board has 7 members from different districts. Each member serves a 14-year term. They're staggered by every 2 years. Therefore, multiple presidents have appointments on the board at any point in time. Therefore, that kind of spreads out the political influence. They are supposed to represent the nation's financial, agricultural, industrial, and commercial interests. So what about the Federal Reserve regional branches? Here you see 12 regional districts. The regions on the East Coast are much smaller, mainly because they were much more populated way back in the day. You can see out in, say, California, spans out to Utah and Washington State. Much bigger. That's just a part of the times. But there's 12 regional districts. Like I mentioned before, a member of the Board of Governors has to come from 7 different districts. Therefore, a district can't have 2 members of the board at one particular time. So what is the goal of monetary policy? Remember, monetary policy controls the money supply and interest rates. So they have 2 main goals. One is to target 2% inflation, and the second is to try to get maximum employment. Now, the key here is that those 2 goals often counteract each other. For example, lower interest rates can lead to lower unemployment, but higher inflation. And both comics on the page show that. It's kind of a seesaw effect. You target one of the goals, and you end up hurting the other. So what tools does the Fed have to achieve those goals? So it comes down to either expansionary policy or contractionary policy. So expansionary policy means a stronger economy, lower unemployment, but then you get higher inflation. So here I have 4 with 1 additional different tools that the Fed can use. And I'll give you an example of what expansionary policy would be for each of these. Now a quick shortcut would be to think expansionary equals banks will lend out money more. So when we go through these, I'll be asking what scenario would cause banks to lend more. So open market operations, which means the Fed is buying or selling government securities. So if they buy securities, they are giving money out to banks. Banks have more money to lend, therefore that's expansionary. Reserve requirements. The Fed can reduce the amount of reserves banks must hold. If they do not have to hold as much money, they have more money to lend. That is expansionary. Interest on reserves. Some banks can actually hold more reserves than required. They get paid interest on that. But if the interest rate is very, very low, then they have more incentive to lend that money out. So a low interest on reserves would be expansionary. That discount rate, which is the rate that the Fed charges banks. The Fed is the lender of last resort. If this discount rate is very low, this gives the banks incentive to borrow from the Fed and then loan that money out at a higher rate to the public. That would be expansionary, low discount rates. And then extreme scenarios like quantitative easing, everything that's happened kind of post-financial crisis, which I'll get into in a little bit. So the Federal Open Market Committee, they decide monetary policy. They get together 8 times per year, target a Fed funds rate, which is hit by buying and selling government securities. The New York Federal Reserve Branch Bond Desk actually does the execution of those trades. The FOMC is filled with the 7 Board of Governors members, the New York Fed president, and a rotating schedule of 4 Reserve Bank presidents. So let's do another example of expansionary versus contractionary open market operations. Contractionary is just the opposite of expansionary here, so I'll just talk expansionary. Kind of already hit it, but I'll just reiterate it so I can hammer the point home. So expansionary policy means they're trying to boost the economy and lower unemployment. So how do they do this? So they buy government securities, generally from banks. What does this mean? They get the government securities or the debt from the banks, and they give banks dollars. So now the banks have more dollars on their balance sheet. And step 2 now, the banks now can lend more money because they have more dollars to lend. Okay, and this is where the rubber hits the road in step 3. So now they have more dollars to lend and they want to lend. But how do they get people to want to borrow? They have to increase demand. Therefore, they reduce the interest rate to entice people to borrow. So this is how the Fed, when they actually buy government securities or debt from banks, ends up causing the interest rate to fall. Let's take a look at the Fed funds rate over time. You can see it varies quite a bit. 1980 through 1982, the economy was fighting quite a bit of inflation. That's why you saw the Fed funds rate at about 20%. Over time, inflation got under control. You can see how the Fed funds rate has declined since then. In 08, 09, you can see a sharp decline in the Fed funds rate from about 5% down to pretty close to 0. And this is the Fed's response to the financial crisis. Then you saw a near 0 Fed funds rate from 2009 through 2016 on this chart. That was a period of quantitative easing. And ever since then, the Fed has been slowly increasing the Fed funds rate. And now it has a target of 2.5%. So let's talk extreme expansionary monetary policy, quantitative easing. This is what we saw after the financial crisis. So what is quantitative easing? It's conducted when rates are near zero, because standard policy will not work in that case. And it's also very important to note that typical Fed policy does not have much of an impact on the long end of the yield curve. So think 30-year bonds, things like that. Everything I've talked about is for very short-term debt. And then in QE, the Fed expanded its balance sheet by buying the debt off banks. You can see a little graphic on the right. You can see dollars going to private banks, financial institutions, and assets going to the Fed. Very similar to open market operations. So let's talk about the QE strategies utilized by the Fed since the financial crisis. So QE1 was from December 2008 through June of 2010. And the Fed bought $2 trillion in U.S. Treasury notes in MBS. MBS is mortgage-backed securities. Now, Treasury notes are 2, 3, 5 year debt issued by the U.S. Treasury. So relatively shorter term debt. QE2, the Fed realized they really need to boost the housing market. And I mentioned they have limited control over the long end of the yield curve. 30-year bonds. Well, what's your mortgage rate based upon? Most people have a 30-year mortgage. They really wanted to decrease the rate on the long end of the yield curve. In order to do that, they had to increase demand for long-term bonds. So the plan was to buy $600 million in longer-dated treasuries in order to help the housing market. At this point, the Fed balance sheet was about $2 trillion. Then we ran into Operation Twist. They want to continue to support housing by buying those longer-term treasuries and MBS. However, instead of increasing the balance sheet, they decided to utilize the proceeds from the shorter-term notes from QE1. So if they bought a 2 or 3 or 5 year note in 2008, 2009, at some point in the next few years, those notes are going to roll off and mature. They could take those proceeds and they would buy longer-term treasuries. In QE3 and 4, they wanted to extend Twist, but they wanted to get a bit more bang for their buck and really, help the housing market. So they decided to increase their balance sheet. So just utilizing the proceeds from the bonds that were rolling off, they decided to add to the balance sheet, so which ballooned to $4.5 trillion. This all led to the middle of 2017, when QE effectively ended, and the plan was to begin to allow the debt to roll off the book with no additional purchases. Their target was to decline their balance sheet by about $30 billion in treasuries and $20 billion in MBS per month. So what about some other responsibilities of the Fed? I mentioned before, bank supervision. They rate the banks under their purview based upon the CAMELS rating system, looking at things like capital adequacy, asset quality, management, earnings, liquidity, sensitivity, with ratings 1 through 5, 1 being better. And they do things like financial services. They are the banker's bank after all, so they make sure paper currency is available. They do ACH, electronic payments, and they process commercial checks. Not all is good with the Fed, according to some, so there's quite a few criticisms. One pretty good book out there is End the Fed by Ron Paul. So what is his criticism against the Fed? So he says the Fed causes economic inequality. Wealthy and crony capitalists feel the benefit of the Fed first. So what does that mean? Well, think about this. If the Fed reduces interest rates dramatically, who are the first people that are able to capitalize on that? People with great credit quality, so they're able to get loans, and the people with more money, because they're able to compound their wealth a lot quicker. Paul also says that the Fed can cause bubbles. So what does this mean? Well, when the Fed reduces interest rates and they're trying to boost the economy, that money doesn't flow to the economy equally to all sectors. The money might flow to, say, one sector. Just think about QE. It was really, a lot of it was based upon boosting up the housing market. So it can always cause bubbles by diverting money to where they want it to be. Another criticism is inflation is a tax on savers, and there's a potential lack of transparency with the Fed. So another big criticism is the lack of transparency, like I mentioned. So there's a big movement out there to audit the Fed. So what does that mean? So let's first be clear. Much of the Fed is already subject to an audit. So you can go on their website, you can see all their holdings. So this whole audit the Fed movement really is about getting more clarity about monetary policy decisions. And more importantly, the key is to make sure banks do not have undue influence on the Fed. So if you look at, say, the background of Jerome Powell, he worked on Wall Street, for example. So there's a lot of connections there. So the audit the Fed movement is to make sure that the banks are not influencing monetary policy. Rand Paul, Thomas Massie, Bernie Sanders, so across the spectrum, support this movement. Seems like it makes a lot of sense, right? But the pushback is that it actually might hurt Fed independence. Why? Because it actually adds more congressional oversight. So, on one hand, you have a less transparent Fed. On the other hand, you have a bunch of political congressmen trying to influence long-term monetary policy. That's not a good idea either. And the main criticism is the declining value of the dollar. So how much is $100 worth today? So if I gave you $100 in 1913, that $100 would only be able to buy you about $5 worth of stuff today. Okay, and you'd say, you know what, I could look in the graph, the red line, it went from 100 to 50 in about 10 years. So that decline happened a long, long time ago. But what if I gave you $100 30 years ago in 1989? That $100 would only be able to buy about $50 worth of stuff today in 30 years. And what if you're a young buck and you're just in college or something like that, and you got $100 in 2009? That $100 in 2009 could only buy about $84 worth of stuff today. So inflation is decaying your purchasing power no matter what. You go back 100 years, 30 years, 10 years, doesn't matter. So what the Fed is doing by targeting 2% inflation, it's really punishing savers who's putting that $100 away underneath the mattress, whatever it is, because inflation's eating away on the purchasing power of that dollar. All right, guys, I really appreciate you joining me today. Hopefully you learned something about the Fed, how it impacts the markets, how it impacts interest rates, how it impacts you potentially buying a house or anything like that, or even getting employed. So if you like this video, please subscribe to my YouTube channel, Crypto Quantamental. You're already here. Like the video, of course, and follow me on Twitter at CryptoQF. I would really appreciate it. Thanks.